Today is round 2 of the Financial Crisis Inquiry Commission hearings into the so-called shadow banking system. On deck today, Treasury Secretary Tim Geithner and his predecessor in that role, Henry Paulson. Dean Baker, co-director of the Center for Economic and Policy Research, has been following all the hearings. Dean has been a consultant to the Congressional Joint Economic Committee. He is also the author of the book False Prophets: Recovering from the Bubble Economy. Dean, speaking of the bubble economy, the shadow banking system played an enormous role. Do you think we're learning enough about the shadow banking system from these hearings, and how might they change our attitude towards it going forward?
Well, I don't think we're really getting that much out of it. I mean, the people coming before the commission, I think, are largely focused on stonewalling. I mean, yesterday we had James Kane, the former CEO of Bear Stearns at the time it went under, and he was still blaming short sellers. I mean, this just wasn't very realistic. Bear Stearns was leveraged at 40-1, and that's basically why it got into really big trouble. So, we're not breaking through this sort of, veneer that everything was okay, just minor this and that. Going forward, though, I mean, I think the real question is, what did the regulators miss and why did they miss it? And, we're going to have Timothy Geithner there, and, he was sitting there at the New York Fed, more importantly than being Treasury Secretary today in this context. He was at the New York Fed when they were buying the repo 105s from Lehman. And I think there's a really good question there. Did he know what he was getting, what the Fed was getting, that Lehman was filling this up with junk? And if he didn't know, why not?
You raise an excellent question, and I do want to get to Geithner and Hank Paulson in a moment. But, Dean, speaking of what the regulators knew and what the regulators didn't know, we actually have a story published today by Bloomberg that talks about how lawyers deep inside the SEC actually noticed and recognized the severity of risks in, say, CDOs and how they posed, or at least there were the possibility for write-downs if banks didn't get those CDOs off their balance sheets quickly enough. This is back in February of 2006, and then also recognizing the risks inherent in Bear Stearns' mortgage book back in August of 2006. So the much maligned lawyers at the SEC actually knew what was going on. It's the regulatory structure at the SEC that didn't allow them to do anything about it. Do you think we're going to get any more insight into that kind of conundrum?
Well, it's possible. And again, this speaks a lot about the issues with regulatory reform, because we're focused on writing a better set of laws and regulations, and that's, of course, good. But at the end of the day, it's regulatory will that matters. And it's a little hard to believe that had the top officials at the SEC really wanted to crack down on this, that they weren't able to do it. So it's very striking to find out that you actually had people at the SEC that understood what was going on, understood the risk, and apparently their higher-ups were not interested in acting. Now, again, I don't doubt that there might have been some bureaucratic obstacles, there might have been some legal issues, but it's a little hard to believe that if the SEC was fully on top of this, that they couldn't have taken matters to the Fed, taken this up and really done something to prevent this disaster.
Dean, we're going to hear from Hank Paulson today, and the sense we get is that his testimony is going to say that there is a role for repos, for money market funds, for securitization, and that the shadow banking system actually should be part of the banking system as a whole. How do you feel about that?
Well, I don't think anyone wants to dismantle the shadow banking system, get rid of repos. I mean, these are deeply entrenched at this point. The point is to put, make this more transparent, to bring it under control. And the lesson, of course, we had with Lehman, with Bear Stearns, really all the investment banks, was they got hugely over-leveraged. They got in over their heads, and it was the government, the taxpayers, the public that paid the risk for that.
Dean, we look forward to the hearings, and thanks very much for your analysis.